Hello guys, I hope so you will be fine. So today we are going to talk about DuPont model for return on assets and return on equity. In the previous lecture, we started actually the profitability ratios. So in profitability ratios, we discussed about how to calculate the gross profit ratio. We also discussed how to calculate the operating profit ratio. We also discussed how to calculate the net profit ratio. And then we also discussed about return on asset and return on equity. So these things we have already discussed these ratios. Actually, the topic is the continuation of these two ratios. So we will study today DuPont model for return on assets and return on equity because these two ratios are divided in component ratios. So those things we are going to discuss. So here we go. So previously we discussed how to calculate the return on asset ratio, and this formula we have already discussed in the last class. And the formula was we always take net income as the numerator. You know, this net income you can get from the income statement, right? And divided by average total asset. How you calculate the average total asset? We always take beginning assets are the total assets at the start of the year, which is also called opening assets. Plus, we always add their closing assets and then we divide with the two. This is how you get the average total assets. But if in case opening assets are not given in the question, then you can use your closing asset. Okay. So don't divide with the two then. So simply you can take your average total assets or you can take what closing assets value. If opening assets are not given, then you don't need to take the average. Okay, just use the closing assets. But the DuPont model begins with the standard equation of ROA that we have already discussed, the standard equation of return on asset. Okay, and simply under DuPont model, so we are going to break it down like this normal formula. We are going to break it down into two component ratios. Okay, the first ratio is called net profit margin and second ratio is called what? Asset turnover ratio. So if you will multiply net profit margin ratio with the asset turnover ratio, so again, what would be the result? Result will be return on asset, right? But the point is that how you will calculate the net profit margin if it is not given in the question straight away. So then this formula you will apply to calculate the net profit margin. What's the formula? Net income we will take as a numerator and we will divide with the net sales. Okay. So this is what is the net profit margin. For example, let's assume net income, I'm just assuming here is $20 and net sale is, let's assume it is, for example, $100. So obviously because net profit margin is always in percentage, so you can also multiply with the 100 to get the answer into percentage. So this is going to be 20%. It means net profit margin is 20%. Now you need to understand what does mean by this 20%. We already discussed this ratio in the previous class. So it means we can say our net income is 20% of net sale value, or we can say this way also, each dollar of sale generates 20% profit. 20% of $1 will be what? $0.2. Right? So this is how you can interpret this ratio. And guys, obviously, net profit margin ratio, we always, desire for higher answer, right? Because it is profit, right? On the other hand, we have a total asset turnover ratio. So total asset turnover ratio, how it is calculated. So the formula is net sales divided by average total assets. And I already told you how to calculate the average total assets. You need opening assets, like total assets at the beginning of the year plus closing assets at the end of year and divide with the two. This will give you average total assets, right? So we have a numerator here as a net sales and denominator is average total assets. Let's assume the value, for example, net sale is $100 and our average total asset is $50. You don't need to multiply with 100. If you want to multiply, let's assume. So it will give you what the answer is, or you don't need to actually multiply with this, okay? Because usually it is in the times, okay? So 100 divided by 50, so you will get the answer is 2. So now you have to understand what if the total asset turnover is 2. So what does mean by this 2? So it means It means we can interpret in two different ways. First way is that your net sale is two times higher than your average total asset. This is the first interpretation. And second interpretation is that each dollar of investment in asset, each dollar of investment in asset, okay, is generating $2 of sale. So this is how you can also interpret. Now, guys, coming back to the main point. So this is what is your DuPont model. So guys, for DuPont model, what is the equation? So it means from today to onward, we have two formulas to calculate the return on asset. And you have to read the question very carefully. So the first formula is simplest formula. The simplest formula to calculate the return on asset is net income divided by average total asset. And the second formula, which is DuPont model. So if you are applying DuPont model, then you need net profit margin that should be multiplied with what? With the total asset turnover ratio. So this will also give you return on asset. Understood, guys? I hope so it is clear. So now please remember, let's understand here two to three more things here, theoretical things I'm going to explain now. Please, guys, as I told you under DuPont model, so which is equals DuPont model, like return on asset under DuPont model equals net profit margin multiplied by total asset turnover. So this will give you return on asset. Now please remember here, guys. So because sometimes question will be theoretical. So if your net profit margin will increase, your return on asset will also increase. Or if your net profit margin will decrease, your return on asset will decrease. On the other hand, if total asset turnover will increase, obviously your return on asset will also increase. Or if total asset turnover ratio will decrease, your return on asset will also decrease. So sometimes they will ask the question, and sometimes, guys, in theoretical question, he will give you information about the formulas component, right? Okay, like for example, under net profit margin. Okay, so he would ask you, for example, what if the net income will increase? So what will be the effect on return on asset? Obviously, if net income will increase, numerator. Okay, so then net profit margin will also increase, and if net profit margin will increase, return on asset will also increase. On the other hand, for example, if net sales will decrease, net sale, because it's the denominator of net profit margin, right? If net sale will increase, so your net profit margin will decrease and return on asset will also decrease. Understood, guys? On the other hand, for example, here in asset turnover ratio, if your net sales will increase, so obviously it will increase your asset turnover ratio and it will increase your return on asset also. Or what if your average total asset increases, for example, if average total assets increases because it's a denominator, so then asset turnover ratio will decrease and return on asset will also decrease. So guys, you have to remember this what is written here. So for the net profit margin, what they are telling you. So net profit margin, they are saying if net sales, because this is the net sales, okay, denominator in the formula. If net sales increases, obviously if net sale will increase, if denominator increases, so net profit margin will decrease. So this is what they're saying, if net sales increases and net income remains the same. So the net profit margin worsens because more sales are generating the same bottom line. Bottom line means here profit. If you are, this is what they're saying, if sales will increase and your profit is unchanged, so your net profit margin overall, it will reduce, right? Because denominator is increasing. So which will reduce your, obviously, return on asset also. Understood, guys? I hope that is clear. So same way I told you already for asset turnover, I told you asset turnover ratio, what it measures. I told you already total asset turnover ratio measures the level of capital investment. Obviously, the investment which you have made into the asset, okay, relative to sales value. Or in simple words, just we are trying to see how efficiently we are utilizing our assets to generate the same. If the answer of this ratio, total asset turnover ratio, just I told you how to find, how to calculate it, right? So total asset turnover ratio, how to calculate it? This is the formula is written here. So net sales divided by average total asset. Obviously, guys, now what they're trying to tell you, they're saying if net sales increases, net sale is the numerator, right? If numerator increases, numerator, if numerator increases, it will increase your asset turnover ratio, and which will increase your return on asset also. So this is what they're trying to tell you. If net sale increase and all other factor remains the same, the asset turnover ratio improves. Because why it improves? Because it's increased in numerator. Because more sales are being produced by the same amount of asset. Then guys, we have a other ratio. Then I'll show you the question, how questions are performed. So we have other ratio for what? Return on equity. Okay. So previously, earlier, so we discussed the formula for return on equity. Okay. Simplest formula. The simplest formula for return on equity is so net income divided by average total equity. Average total equity, how you calculate? We need opening equity value plus closing equity value and we divide with that. This is how you get the average. Understood? If opening equity is not given, then this closing equity you can also divide it. Simply net income divided by closing equity. Average is required if opening and closing equity both are available. Okay, guys, this is the simplest formula. And for example, we discussed the interpretation of this ratio also. For example, net income, I'm assuming, let's assume $10. Average equity is, for example, $50 and multiply by 100. So my return on equity is 20%. So what does mean by is 20%? So we can simply say net income is 20% of equity value. Or each dollar invested in equity is generating 20% profit. Okay. So 20% of $1, which is going to be $0.2. This is the simplest formula. But under DuPont model, so this return on equity formula is subdivided, okay, into three different efficiency components, into three different ratios. So this is the DuPont version, okay, of return on equity. So please remember DuPont, this is the DuPont version. So of return on equity. So how it is calculated? So we will always take net profit margin. Okay, net profit margin, I already told you how to calculate net income divided by net sales. So this will give you net profit margin. Multiply by asset turnover ratio. Asset turnover ratio, I also told you already how to calculate it. Net sales divided by average total asset. By the way, when you multiply net profit margin with the turnover, so this is called return on asset, right? So this return on asset, actually you are going to multiply with what? With the third component, which is called equity multiplier. So what is equity multiplier? So this is the formula for equity multiplier. Look at the formula and then I'll interpret. Okay. So simply if the return on asset, if you will multiply with the equity multiplier, so this will give you return on equity. Okay. So three things we have now. Net profit margin, multiply by asset turnover ratio, multiply by equity multiplier. So how to calculate equity multiplier, which is the new thing here. So this is the formula for equity multiplier. So we always need average total assets. Average total assets, I already told you, opening assets plus closing assets divided by 2. This is the average total assets. Okay, this is the formula for average total assets. So average total assets divided by average total equity. And total equity, I already told you, opening equity plus closing equity divided by 2. This will give you average. So guys, if you will take average total assets divided by average total equity, this is called equity multiplier. So let me first put the figures here and then I'll interpret what it means. For example, guys, average total assets are, I'm just assuming, let's assume is $100. And average total equity is, for example, $50. So answer is of equity multiplier is 2. Okay. So what does mean by 2? So we can interpret in different way now. So please, first I'm just going to tell you a layman interpretation. So we can say here, our asset value is 2 times higher than our equity value. But actually, guys, the true interpretation for equity multiplier is, so actually this ratio measures financial leverage. What it measures? Financial leverage. Like usually in accounting, we know our assets are always equals to what? Liabilities plus equity. Now, if you will understand here, so as per my Zoom data, if assets are 100 and my equity value is 50, obviously my liability value is also 50. Right or wrong? So guys, actually, whenever we calculate equity multiplier, it measures financial leverage. And financial leverage mean to say how much portion of our assets are financed, or how much portion of our asset is financed to the debt financing. For example, here, here, if answer is 2, it means our assets are 2 times higher than equity, right? So if answer is 5 here, let's assume if this answer is 5. This answer is 5. So you have to think now this way. So it means your assets are 5 times higher than equity, right? It means why it is 5 times higher? Because you are using major portion of debt to finance our assets. So let's understand, if our average total assets are 100 and equity is also 100, equity is also 100. So then, obviously, if equity is also 100, then answer will be 1. It means our asset is equal to equity. But if assets are average assets are 100, but my equity value is only 20, so it means now answer is what? 5. So 5 means what? My assets are 5 times higher than equity. If answer is higher, it means actually I'm using bigger portion of debt to finance our assets. Understood, guys? So please remember, guys, whenever answer for equity multiplier is higher, don't think so it's a positive sign. No, it means if answer is higher, so you are using bigger proportionate of debt to finance your assets. If answer is lower, it means you are using less proportionate of debt to finance your asset. And obviously, if answer is higher, because you are using bigger proportionate of debt to finance your asset. So on the one side, it is risky also, right or wrong? Because as you raise further debt, obviously it increases the risk for the business. Because there are more chances, right? If you will be in the losses, so there are more chances that you will default because you have high burden of debt. Understood? So guys, this is what is the DuPont model. Now, if I'll revise all these three things, what I told you in summary. So for return on asset, we have a two formula. One, we have a simple formula, and second, we have a DuPont model. In simple formula for return on asset, I told you formula is net income divided by average total assets. This is return on asset. But DuPont model is, so return on asset equals what? So we need net profit margin ratio. Net profit margin ratio. Okay, which is net profit margin ratio. How you calculate? Net income divided by net sales. Right? Multiply by asset turnover ratio. And for asset turnover ratio, I already told you how you calculate asset turnover ratio. Do you remember the formula? So for asset turnover ratio, the formula is written here. It is net sale over average total assets. Net sale divided by average total asset. So this is DuPont version. And on the other hand, if you are calculating return on equity, guys, or the return on equity, we have again two versions. So simple formula, say, and DuPont model. So simple formula is what? Net income divided by average total equity. But the DuPont version, it has three components. So net profit margin ratio multiplied by asset turnover ratio multiplied by equity multiplier. Right? So net profit margin, you know how to find out if it is not given. So how to find it if it is not given? So net income divided by net sales. Right? And asset turnover ratio, net sales divided by average total assets. And equity multiplier, how you calculate equity? Average total assets divided by what? Average total equity. Right? So guys, this is how we find out, guys. So So if you will just see how this simplest formula is derived, you can just see the logic here. This net sales will be crossed by with this net sales. This average total asset will be crossed by with this average total asset. So that's the remaining formula is net income divided by average total equity, right? So similar way, you can check it here how this basic formula is for return on asset. How this simplest formula is derived, this one. So you will take this net income, sorry, this net sale and this net sale will be crossed with each other. So remaining thing is net income divided by average total assets, right? This is how these formulas are derived actually. But if in your exam question, if you would ask you to apply DuPont model, so you have to look for those components. But if it's asking to apply simple ratios, so you have to look for simple ratio components, okay? Now guys, please remember here now, let's have a look. Uh, Let me tell you here now for return on equity, please. Guys, if you are now I'm changing just color here, if net profit margin increases, our asset turnover ratio increases, our equity increases. So what will happen? Return on equity will increase also. But if net profit margin decreases, or asset turnover ratio decreases, or equity multiplier decreases, so your return on equity will also decrease. Right? So you have to understand all these things, guys. So now let me show you some couple of questions so you can get the idea how questions will be tested from these two ratios. So here we go. Okay, guys, so here is the interpretation of equity multiplier. Okay, so I would request you, so you can just pause the video here and go through this equity multiplier because high, if equity multiplier is higher, you know, the third component of return on equity. So equity, if equity multiplier is higher, actually it means you are using more proportionate of debt. So your company can become more risky also. But if equity multiplier is lower, it means you are using less proportionate of debt to finance your asset. Okay. So I would just suggest you to go through this because most of the students, they are not well aware with the interpretation of equity multiplier. So now guys, let me show you questions here, how question will be tested. So here we go. Question number one. So they're saying according to the DuPont formula, which one of the following will not increase a profitable firm's return on equity? Actually, the question is, which option will not increase your return on equity? Which option? You have to select that option which will not increase your return on equity. So a DuPont model is there. Do you remember DuPont model equation? So let me write here return on equity. Under DuPont model is, so we need net profit margin ratio multiplied by asset turnover ratio multiplied by equity multiplier. Okay. So now let me write the formula here also. Net profit margin, how you calculate? Net income divided by net sales. Right? And asset turnover ratio, how you calculate? Net sale divided by average total assets. Okay. And the third equity multiplier is how? Average total assets divided by average total equity. Okay. So now the question is, this is how you calculate what? Return on equity. The question is which factor will not increase return on equity? So here we go. Number one, I'm reading from here. Increasing net profit margin. Guys, if your net profit margin will increase, obviously return on equity will increase. So this is not the option because the question is which will not increase your return on equity. Second thing they're telling you, Lowering corporate income tax. Okay. Actually, this is, income tax. It's a tax expense. Yes, guys, please remember here. Please remember. So tax expense. If you will lower the tax expense, like if tax rates are less, so actually your net income will increase. Your net income, because in income statement we deduct tax as expense. So if your tax expenses has reduced, so your net income will increase. If net income will increase, so net profit margin will also increase, which will increase the return on equity. So that is why this is also not the option, because the question is which will not increase, okay, the return on equity. So this will increase the return on equity. Then what? Increasing total asset turnover ratio. Yes, if asset turnover ratio will increase, return on equity will also increase. So this is also not the option. The question is which will not increase the return on equity. Next, lowering equity multiplier. Yes, if equity multiplier will be less, so return on equity will be less. So this is the answer of question, because the question was which will not increase the return on equity. So lowering the equity multiplier, if you will reduce the equity multipliers, it will not increase the return on equity. So this is the answer of the question, guys. So A is the answer. Okay, guys, so next question we have now. Look, so we have another question here. First, have a look. They're saying using the above data, the firm's return on equity. Again, you have to find return on equity using DuPont model. Okay, so here we have a data on the question. Now, if you will go through the question, so then we'll apply the formula of DuPont model to find out return on equity. So what is the question? We have here assets at the beginning of year. We have assets at the beginning of year and at the end of year. Liabilities at the beginning of year, at the end of year. Shares outstanding. These are number of shares at the beginning of the year and at the end of the year. We have market price per share at the beginning of year, at the end of year. We have value of sales. We have earning before interest and tax. We have interest expense. We have a tax rate. And now we have to find out return on equity by applying DuPont model. So guys, I'm just going to write it here. Formula for return on equity. Okay. So let's write the formula. So the complete formula is, for DuPont model, guys, return on equity equals net profit margin ratio multiplied by asset turnover ratio and multiplied by equity multiplier. Okay. So if you will just write the other components of this net profit margin, how you calculate? So return on equity. Net profit margin, how you calculate, guys? Net income divided by net sales. And asset turnover ratio, how you find out? Net sales divided by average total assets multiplied by equity multiplier. So average total assets divided by average total equity. Okay, so this is the complete formula. Now let's have a look what is given, what is not given. If I'll go through this information from here till here, so from here I can at least get net income. Okay, so how you will find net income? I'm just solving here, guys. Net income you will find this way. So we have already given earning before interest and tax. So EBIT is given. How much it is given? 1.7 million. From there, if I deduct interest expense, which is also given in the question, 500,000. So this will give you earning before tax, which is 1.2 million. From there, if you will deduct tax expense, which is tax is 40%. So if we'll apply 1.2 million times 40%. So it is going to be 480,000 tax. And this is called your net income now. So net income is 720,000. So one value we found net income. So we can write it here. So return on equity. Net income is 720,000 divided by net sale. Net sale is given in the question. Net sale is here. Sale is it's sales. It's not net sales. Because sales and net sale. Net sale means the sales after returns, right? So it means here we can assume the sale is your net sale, which is 22 million. So 720,000 divided by 22 million. So if you would just solve it first, at least we can get this answer first. So 720,000 divided by 22 million. So answer is 3.27%. Okay. Because this ratio is in percentage. If you don't want in percentage, so you can just write without percentage add, then you can multiply with the 100. So here we go, guys. Then net sales. Net sale we know the net sale. This is the value of net sale, right? 22 million divided by average total assets. Okay. So let's go back to the question. So this is the assets. Assets are given. Opening assets at the beginning of a year, closing assets at the end of the year. So if I take opening assets plus closing assets divided by 2. So opening assets are how much? 9.6 million. Closing assets are 10 million and divided by 2. So this will give you average. So let's find out. So we have 9.8 million. So this is your average total assets. So we'll write it here. Average total asset is 9.8 million. At least if I'll solve it, I can get also asset turnover ratio from answer also. So we have here 22 million divided by 9.8 million. So answer is 2.24. Now we can solve the third one also. Third one is what? Average total assets. Okay, this is the average total assets. 9.8 million. Now you have to find average total equity. Let's go back to the question. Average total equity. If you will go through the question, whole question, maybe you will not find where average total equity is given. It's not given. You have to find out equity. So guys, you know equity, how you can find. So if I'll apply this equation, that assets minus liabilities equals equity. So I can find this here because assets are given, liabilities are given. So equity value I can find. Like opening assets minus opening liabilities. So how much is the equity value? So opening assets are 9.6 million and liabilities are how much? 6.2 million. So opening assets are, opening equity is what? 3.4 million. This is the opening. Now we can find the closing also by taking this asset minus liability. So 10 million minus 6.8 million. So it is going to be 3.2 million. So this is the closing. So now we can find out opening plus closing divided by 2. So opening is how much? 3.4 million. And closing is how much? 6.8 million divided by 2. So, sorry, it's wrong value. This value is how much? 3.2 million. So let's find out. The value is 3.3 million. This is the value of average equity. Now if you will solve it, so 9.8 million divided by 3.3 million. The answer is 2.97 of equity multiplier, right? Now we will multiply all these three values. So this will give you what? Return on equity. So here we go. So 3.27 times 2.24 times 2.97. So answer is 21.75. So rounded value is 22%. Okay, so this 22% is the answer, which is the 20 C option. Okay. So this is the return on equity. Okay, guys, this is how you will find from this question. So now let's move to the next question. This is the question which we have already solved now. Okay, guys. So here we go. Next question. So we have here another question. They are saying that last year a corporation had a total asset turnover ratio 1.5, a profit margin of 10%. Profit margin means the net profit margin, net income. Okay. And an equity multiplier of 2. It means, can you tell me what was the return on equity in the last year? Return on equity by using DuPont model. So we have our net profit margin multiplied by asset turnover multiplied by equity multiplier. So net profit margin is 10% last year. Asset turnover ratio was 1.5 and equity multiplier is 2. It's given here. So it means return on equity was in the last year was how much? 30, right? 30%. Just cross check, okay? So 10 times 1.5 times 2. It is 30%. Yeah, 30%. Now what they're saying? Now they're saying that this is information of last year. Now they're saying if the net profit margin is 8%. Now, if net profit margin is 8%, but return on equity stays the same because return on equity was 30%. They're saying now assume if net profit margin is 8% and return on equity is 30%, then what could be true? So you have to tell which option is correct. Option number one, they are saying that now the condition is that, guys, now the condition is that your return on equity should stay 30%, which is equals net profit margin ratio. Net profit margin ratio, which is 8% now, because it already now it is 8%. And asset turnover ratio is not given, and equity multiplier is not given. Okay, and he's asking which is the correct option. The option you have to select which will give you 30% answer by fitting this information. Number one, if equity multiplier 2, okay, if I'll keep equity multiplier of 2 and total asset turnover ratio is 1.7, tell me answer is 30% or more or less. If it is 30%, so then this is the answer of the question. If it is not 30%, because return on equity, they're saying it stays the same. So we have 8% multiplied by 1.7 multiplied by 2. So answer is 27.2. No. So this, if you will fit this data here, so you will not get 30%. So it means this is not the option. Because return on equity final answer should stay the same. Then the equity multiplier, now let's change the information. They're saying now if equity multiplier is 2, okay, keep it 2. And total asset turnover ratio is 3.5. Check. Now multiply 3, check it is 30%, more or less. So 8 times 3.5 times 2. So it is 56%. No, it's not the option. So this gives you 56%, not 30%. So this is the answer, not the option. So remove this. Now we have a third option. They're saying if equity multiplier increase to 3, okay, keep it 3. And total asset turnover ratio is 1.25. Check now answer is 30% or not. Because they told you return on equity stays the same. 8 times 1.25 times 3. Yes, now it stays 30%. It means this is the answer of this question. Now if you will apply the fourth one, keep net profit margin 8%. Fourth is what? If equity multiplier is 2.2, okay, keep it 2.2. This is 2.2. And asset turnover is 1.5. Okay, just try it. 8 times 1.5 times 2.2. So it is 26% almost. No, this is not the option. So option C is the correct option. I hope so, guys. It is clear this question. Now, guys, we have here another question. Let's go through this question. So this is the requirement. First, I'm going to go through the requirement of the question. They are saying that approximately How much does the company's return on total assets, its return on asset, ROA, how much does the company's ROA increase between year one and year two? So you have to actually tell. You have to tell with which percentage ROA, return on asset, has increased from year one to year two. So it means, guys, first of all, we need to find out return on asset in year one, right? Then you have to find out return on asset in year two. Then we can see how much it has increased or decreased. So here we go. Let's go to the question now. At the end of first year, a company had average total assets of 450 million yen. Okay, 450 million yen. This average total asset is given. So let's apply the formula for return on asset, because here we don't need to apply DuPont model. Okay, simply we'll apply basic formula. So return on asset equals what? Net income divided by average total assets. Same formula you will apply here. Net income divided by average total assets. So in year one, average total asset, he already told you 450 million yen. Okay, new denominator is given. So what's the numerator? Average total liabilities of 150 million we don't need. We need assets. Assets are given. And net income we need. It's given in 135 million. So net income is 135 million. So 135 million divided by 450 million and multiply by 100. So it is going to be 30% return on equity in the first year. Now you have to calculate return on equity in the second year. So here we go. Then they're saying the company's management projects average total assets to increase by 50 million in year two. They're saying your average total asset will increase by 50 million in year two. It means in the year one, average total asset was 450 million, plus it will increase by 50 million. So total will be 500 million now, right? Because average total asset is increased by 50 million. Okay, it means 450 million is there, plus further it is increased by 50 million. So total average total asset will become 500 million. Okay, so denominator we got. So let's have a look to the numerator now, net income. Then they're saying that why this 50 million has increased. They're saying due to the planned purchase of new manufacturing plant. Because we are planning to buy a new plant. That is the reason this will increase your average total assets. So the company will issue 30 million in the new debt at the beginning of year two. Guys, this is because happened at the beginning of year two. So we will assume it is already included in year two data. So no debt was paid down during year one. We told you we didn't pay anything, any debt in year one. If management projects net income to increase by 25% in year two, it means we should know what's the net income in year one. So that net income will increase by 25% in year two. So here we go. Net income in year one was 135 million. If I will increase by 25%, right? This is actually math, okay? 135 million into 1 plus increase. So increase is 25%, right? So 1 plus increase. So increase is 25%. So if I'll remove the percentage, actually this is a complete mathematical equation, okay guys? So write the amount 135 million into 1 plus 25%. This is what it means. So okay, so this 25%, if I'll remove the percentage, it will become 0.25. And 1 plus 0.25, it will become 1.25, right? So if I'll multiply 135 with the 1.25, I will automatically get the net income, which is increased by 25%. So 135 times 1.25. So it means my net income is going to be 168.75 million. This is my net income. This is my average assets. So just divided by 500 million. So my return on asset and multiply by 100. So my return on asset will be 33.75%. See, in year one, my return on asset was 30%. And in year two, my return on asset is 33.75%. Now the question is how much does the company's return on total asset increase between year one to year two? Guys, don't consider this way. It was 30% and it is 33.75%. So you don't say it is increased by 3.75%. No, it is totally wrong. You have to calculate actually trend. And trend, how you will find out? So you will always take new percentage minus old percentage divided by old percentage multiplied by 100. This will give you trend actually increase and decrease percentage. Okay. So new percentage is 33.75% minus old percentage is what? 30% divided by old percentage, which is 30%. So, and multiply by 100 because I'm using full value, so I don't need even to multiply by 100 because I'm using full value because I'm not using like that. If I'm using value like that, by removing the percentage, so this will become 0.3375 and this will become 0.30 divided by 0.30. Then I need to multiply with 100 to get the answer into percentage. So here we go. So if you will solve it, it is going to be 12.5%. Okay, guys. So here you also need to multiply with 100, okay, to get the answer into percentage. It will be 12.5%. Even you are writing this way or this way, so you have to multiply with 100 because we are calculating the trend, guys. Okay. So I hope so it is clear. So it means our return on asset increased by 12.5%. Okay. So 12.5 means a 13%. So this is the closed option, right? Because other options are 20%, 17, 11. So this is the more closed because 12.5% will become rounded value as 13%. Guys, I hope so it is clear. See you next time in the next video. Thank you so much. Bye.